In 1776, Adam Smith published a warning that would echo across centuries. In The Wealth of Nations, he cautioned against the dangerous alliance between government power and concentrated private interests. He observed that merchants and manufacturers, when granted special privileges by the state, would pursue their own advantage at the expense of the public good. Smith worried particularly about large trading companies that enjoyed government protection and monopolistic advantages. He could not have imagined the scale of what would emerge 230 years later, but his analysis proved prophetic. In September 2008, the American government faced a choice: allow major financial institutions to fail or intervene to prevent their collapse. The decision was framed as necessity. These institutions were too big to fail. Their collapse would trigger systemic catastrophe. The government chose rescue. What followed was not a temporary emergency measure, but the establishment of a permanent architecture of bailouts. This is not opinion about whether the rescues were justified. This is documentation of how the concept of too big to fail became embedded in the financial system, the consequences that followed, and why Adam Smith's warnings about the corruption of free markets by government favoritism have never been more relevant. The phrase "too big to fail" entered common usage during the 2008 crisis, but the concept has deeper roots. In 1984, Continental Illinois National Bank faced collapse due to bad energy loans. Federal regulators decided that the bank's failure would threaten the entire financial system. They arranged a rescue, protecting not just depositors but also bondholders and counterparties. The intervention established a precedent. Large institutions enjoyed implicit government backing. This created what economists call moral hazard. If institutions know they will be rescued, they have incentive to take excessive risks. Profits are private. Losses are socialized. Adam Smith identified this problem in his critique of joint stock companies and government-backed trading monopolies. When risk and reward separate, when those making decisions do not bear full consequences, behavior becomes reckless, and resources misallocate. The 2008 crisis brought this moral hazard to catastrophic fruition. Financial institutions had grown to unprecedented size through decades of deregulation and consolidation. The largest banks held assets worth trillions of dollars, larger than the GDP of most countries. They were deeply interconnected through derivatives, counterparty relationships, and funding markets. Their balance sheets were opaque, their risk models flawed, their capital inadequate. They had made enormous bets on housing markets using borrowed money. When housing prices stopped rising and began falling, the entire structure became unstable. Bear Stearns collapsed in March 2008, rescued through a government-facilitated acquisition by J.P. Morgan. Lehman Brothers filed for bankruptcy in September 2008. The decision to let Lehman fail, breaking the pattern of rescues, triggered panic across global financial markets. The panic forced government action on a scale never before attempted. In peacetime, the Federal Reserve created emergency lending facilities that pumped trillions into financial markets. The Treasury Department proposed a $700 billion troubled asset relief program to purchase toxic assets from banks. The Federal Reserve purchased mortgage-backed securities and Treasury bonds in unprecedented quantities. The scale of intervention dwarfed anything in American history outside of world wars. Adam Smith would have recognized this pattern immediately. In his era, the East India Company and other chartered corporations enjoyed government monopolies and bailouts when they faced financial difficulties. Smith observed that such arrangements corrupted both markets and government. Companies used political influence to secure advantages. Government officials made decisions based on political connections rather than economic merit. The public bore costs, while private interests captured benefits. Smith's solution was clear. Remove government protection, allow failure, let market discipline operate. In a genuine free market, bad decisions lead to bankruptcy. The threat of failure enforces prudence. Resources flow to competent managers and sound businesses. But when government guarantees prevent failure, these mechanisms break down. The immediate defense of the 2008 bailouts centered on systemic risk. Officials argued that allowing major institutions to fail would trigger cascading collapse. Banks would stop lending, credit would freeze. Companies could not finance operations. Unemployment would explode. The entire economy would spiral into depression. These arguments carried weight. The Great Depression demonstrated how financial collapse could devastate the real economy. The Lehman bankruptcy showed how quickly panic could spread. Federal Reserve Chairman Ben Bernanke and Treasury Secretary Henry Paulson genuinely believed they were preventing catastrophe. Their actions probably did prevent deeper immediate collapse. But this analysis ignores long-term costs and incentive effects that Smith understood clearly. The moral hazard problem intensified after the bailouts. The largest banks not only survived but grew larger. J.P. Morgan acquired Bear Stearns and Washington Mutual. Bank of America acquired Merrill Lynch and Countrywide. Wells Fargo acquired Wachovia. The crisis eliminated competitors and concentrated the industry further. The 6 largest banks controlled over 60% of banking assets, up from around 40% before the crisis. They were now explicitly too big to fail. Everyone understood that government would not allow them to collapse. This knowledge fundamentally altered behavior. Banks could borrow more cheaply than smaller competitors because creditors knew government backing reduced default risk. They took larger risks because downside was limited. They grew even larger because size itself provided protection. The regulatory response, embodied in the Dodd-Frank Act of 2010, attempted to address these problems without fundamentally changing the structure. The legislation created new regulatory agencies, imposed capital requirements, mandated stress tests, and established resolution procedures for failing institutions. These reforms had value. Banks did increase capital ratios. Supervision did intensify. But the fundamental problem remained. The largest institutions were still too large and too interconnected to allow failure without severe consequences. The resolution procedures were untested and likely unworkable in actual crisis. The regulatory complexity created opportunities for avoidance and capture. Most importantly, the implicit guarantee persisted. Markets continued to price in government backing. Adam Smith's analysis suggests that the problem was not insufficient regulation, but excessive size enabled by government protection. In a true market economy without bailout expectations, institutions would not grow to systemically dangerous scales because creditors and counterparties would demand higher returns to compensate for failure risk. This market discipline would limit size naturally. Large institutions would need to hold more capital, reducing returns and growth incentives. The most complex and interconnected structures would face funding challenges as counterparties demanded security. But bailout expectations eliminate this discipline. Creditors lend freely to large institutions at low rates because they expect government rescue. This subsidy enables the very size and complexity that creates systemic risk. The political economy dimension reinforces these dynamics. Large financial institutions have enormous political influence. They employ armies of lobbyists. They make substantial political contributions. They hire former government officials and provide lucrative post-government employment to regulators. This creates what economists call regulatory capture, where regulators serve industry interests rather than public interest. Smith observed identical patterns with the East India Company and other chartered corporations. Government officials who should have policed these entities instead protected them. The entities returned the favor through patronage and political support. Breaking this cycle requires not more complex regulation, but simpler rules and credible commitment to allow failure. The European experience paralleled and even exceeded American patterns. European banks grew even larger relative to their national economies. When crisis struck, governments faced impossible choices. Iceland's banking system had assets worth 10 times national GDP. When Icelandic banks failed, the government could not possibly rescue them. The country faced effective bankruptcy. Ireland guaranteed its banks and nearly destroyed its national finances. Greece, Portugal, Spain, and Italy all faced banking crises intertwined with sovereign debt crises. The European Central Bank and European Union ultimately provided support, but only after severe economic pain. The European crisis demonstrated even more clearly than the American crisis how oversized banking systems hold governments hostage. The continuing saga illustrates that the problem persists and perhaps worsens. In 2023, Silicon Valley Bank and several other regional banks failed due to interest rate risk and poor management. The federal government and Federal Reserve moved quickly to prevent contagion. They guaranteed all deposits, not just those below the insured limit. They created emergency lending facilities to support other banks. The speed and scale of intervention, while perhaps preventing wider panic, reinforced the bailout expectation. Any bank large enough to threaten confidence will receive support. This guarantee extends not just to the systemically important giants, but increasingly to a broader range of institutions. The international dimension adds complexity. The largest banks operate globally. American institutions have European subsidiaries. European banks have American operations. Asian banks have branches worldwide. When crisis strikes, questions arise about which government bears responsibility for rescue. The 2008 crisis revealed dangerous ambiguities. When Lehman Brothers failed, its London operations threatened the UK financial system. Regulatory cooperation was inadequate. Since then, agreements have been reached about cross-border resolution, but these agreements remain untested in actual crisis. The global nature of modern banking means that too big to fail is now too big to fail globally, requiring international coordination that may not exist when needed. The accounting dimension reveals hidden costs. When governments rescue financial institutions, they typically do so through mechanisms that minimize recorded costs. Loans and guarantees do not appear as budget expenditures unless losses materialize. Purchases of assets are recorded at face value, even if market value is lower. Central bank operations expand balance sheets, but do not count as fiscal spending. These accounting choices obscure true costs. The Federal Reserve, for instance, purchased trillions in mortgage-backed securities and treasury bonds. These assets sit on the Fed's balance sheet, earning interest that flows to Treasury. But if the Fed ever needs to sell these assets and takes losses, those losses ultimately fall on taxpayers. The true fiscal cost of financial rescues far exceeds official figures. The distributional consequences are profound and directly relevant to Smith's moral philosophy. In The Theory of Moral Sentiments, Smith emphasized justice and fairness as foundations of social order. The bailouts violated these principles spectacularly. Financial executives who made reckless decisions retained their positions and often their bonuses. Shareholders who should have been wiped out retained value. Bondholders who should have taken losses were protected. Meanwhile, ordinary citizens lost jobs, homes, and savings. The perception, accurate in many respects, was that the system protected the wealthy and powerful while letting ordinary people suffer. This perception has corroded faith in both market economies and democratic governance. The political consequences include rising populism, economic nationalism, and rejection of establishment institutions. The alternative approaches were available, but not pursued. The government could have nationalized failing institutions, protecting the financial system while wiping out shareholders and replacing management. This was done successfully in Sweden during its early 1990s banking crisis. The government took control, cleaned up balance sheets, then reprivatized. Taxpayers ultimately profited. In the United States, this approach was rejected as too radical, despite historical precedent. The government could have broken up the largest institutions, either during the crisis or afterward, reducing future systemic risk. This was not seriously attempted. The government could have imposed strict limits on size and complexity going forward. The Volcker Rule within Dodd-Frank attempted a mild version of this, but it was weakened through lobbying and regulatory implementation. Adam Smith's prescription would likely have been more radical. He believed that markets work best when competition is vigorous, when failure is possible, and when government intervention is minimal and rule-based rather than discretionary. Applied to banking, this suggests several principles. First, no institution should be too big to fail. Size limits or structural separations could ensure this. Second, capital requirements should be much higher, perhaps 20 or 30% of assets, rather than the single-digit percentages typical today. This would create genuine loss-absorbing capacity. Third, activities that create systemic risk, particularly complex derivatives and interconnected funding arrangements, should face strict limits or prohibition. Fourth, and most fundamentally, government must credibly commit to allowing failure. This requires both legal frameworks and political will. The credibility problem is severe. Even with perfect rules, when crisis arrives, political pressure to intervene becomes overwhelming. In the moment, allowing a major bank to fail seems to risk catastrophe. The long-term moral hazard costs seem abstract compared to immediate panic. This dynamic means that rules and frameworks, no matter how well designed, may not hold. The only solution might be to make institutions small enough that their failure truly does not threaten the system. If hundreds of banks each hold less than 1% of system assets, no single failure causes panic. This was roughly the structure that existed in the United States before the deregulation and consolidation of recent decades. Smith would have recognized it as more consistent with competitive markets. The technological dimension introduces new complications. Modern banks are deeply embedded in payment systems, derivatives clearing, and global financial plumbing. Untangling a major institution's operations in bankruptcy would be enormously complex. Computer systems are integrated across business lines and geographies. Contracts number in the millions. Counterparties span the globe. This operational complexity, separate from but related to size, creates additional barriers to allowing failure. The response should probably be to simplify structures, require operational separability, and ensure that critical functions can be transferred quickly. But the trend has been toward increasing complexity rather than simplification. The philosophical question underlying all this is whether capitalism can function with this degree of government intervention. Smith's vision of market economy rested on private property, freedom of contract, and bare consequences of one's decisions. When government systematically prevents consequences for a favored class, the system is no longer the competitive capitalism Smith described. It becomes something else, perhaps best described as a corporate-state partnership, where large private entities enjoy public backing. This arrangement combines the worst features of both systems: the profit motive of capitalism without market discipline, and the power of the state without democratic accountability. Smith warned against precisely this combination. The current state of affairs represents a stable but corrupt equilibrium. Banks understand they have implicit backing. They behave accordingly. Regulators understand political reality and design rules consistent with it. Politicians receive campaign contributions and avoid confronting powerful interests. Economists debate technicalities while ignoring fundamental structure. The public grows cynical, but lacks power to force change. This equilibrium could persist for decades, as similar arrangements have in other times and places. Or it could break suddenly, when crisis overwhelms the government's capacity to rescue, or when political legitimacy erodes to the point where rescues become impossible. History suggests that corrupt equilibria eventually collapse, but timing is unpredictable. The international comparisons offer little comfort. No major developed economy has solved this problem. Japan has zombie banks propped up by government support. China has a banking system that is essentially an arm of the state. European banks remain oversized and politically protected. The British financial system is dominated by a few huge banks. Only a handful of smaller economies like Canada maintained somewhat more conservative banking structures, and even they faced pressures during crisis. The global nature of finance means that no single country can easily pursue a radically different approach. If American banks were forcibly shrunk, while European and Asian banks remained large, the international competitive implications would be significant. The generational question looms large. Young people entering the economy today face a system shaped by bailouts they did not support to protect institutions they do not trust. The costs of those bailouts, in terms of government debt and moral hazard, will burden the economy for decades. Meanwhile, the threat of future crisis and future bailouts remains. Each rescue makes the next more likely by reinforcing expectations and incentivizing risk. Breaking this cycle requires political will that currently does not exist. It would require acknowledging that the bailouts, while perhaps necessary in the moment, created long-term problems that must be addressed rather than perpetuated. As we document this pattern, we observe a system that has moved far from the competitive market economy Adam Smith described and defended. He believed that markets, when allowed to function without government interference or special privilege, would allocate resources efficiently and promote broad prosperity. He recognized that this required letting failure occur, allowing creative destruction, and preventing concentrated power. Most importantly, it makes the next crisis more likely and more severe. The archive documents this progression. Smith's analysis, written 2.5 centuries ago, explains it clearly. The question is whether the lessons will be learned before the next collapse, or only in its aftermath. History suggests the latter is more probable than the former.